Good morning, ladies and gentlemen, and welcome to KPMG's webinar on the economic substance regulations in the UAE. We run this as a series of webinars, and many of you will have attended our previous sessions. The regulations are new. The revised regulations have been issued, but the focus of this webinar is to go through some of the developments as far as the recently introduced notification and reporting guidelines and the formats that have been issued, and focus in particular on some of the economic substance tests that need to be met and some of the practical challenges that businesses may be facing currently as you may be evaluating the impact of those tests on your operations, particularly for 2019. With me today on the webinar, the next slide. To introduce myself, my name is Nilesh Asher. I'm an international tax partner with KPMG in Dubai, and I will be your moderator for this webinar. I'm joined by two of my colleagues from the international tax team, Olga Ermoleva and Philippe Bokovic, both experienced directors in the field of international tax, transfer pricing, and ESR. So I'm delighted that we will have Olga and Philippe talk through today's session. Moving on. In terms of the agenda, as I said, while the new economic substance regulations were issued a month and a half ago, and some of you may have attended KPMG's previous webinar where we ran through some of the developments in more detail. The purpose and the focus of today's webinar is really to look at the newly introduced notification forms and reports that have been introduced by the Ministry of Finance, along with the guidance on these areas and what some of the practical issues or challenges that businesses may be facing there as they prepare to collate the information for the report. But importantly, as part of the reporting requirement, businesses do require to meet the economic substance tests. So we'll run through and focus on these tests in a bit more detail to understand, what some of the issues and challenges there could be, and how, how businesses may be able to deal with the satisfaction of the tests, and then winding up with some thoughts in terms of what we consider some of the actions for businesses in the next 2 months, particularly as you gear up for reporting, and finally we'll keep some time for Q&A as well as your questions come through. In terms of moving on, in terms of the housekeeping, as far as your questions are concerned. Your mic is on mute, as you would have noticed, but you do have the ability to put questions in the Q&A button on the right-hand side of your screen. At the Q&A session, we'll attempt to answer as many questions as we possibly can. So do keep sending your questions through as the webinar progresses. It'd be great to be able to address as many as possible at the end of the session. When the webinar is over, you will be directed to an exit survey. It's important for us to listen to your feedback. We've already done that, and one of the areas of feedback was for us to talk in a bit more detail on the substance tests, which we are doing. So it is important to us to take a minute or so to complete your feedback and send that through to us. Also, that you're aware, the session is being recorded, and a link to the recording will be shared with you within 48 hours of the webinar. So with that administration points out of the way, let's get started straight away, and I will request my colleague Olga to take us through the initial sessions in terms of the updates to ESR and the notification and reporting template. Olga, over to you.
Thank you, Nilesh, and good morning, everyone. Can we move to the next slide, please? Yeah, I would say that recently the Ministry of Finance has been quite active and released all forms and guidelines required for implementation of economic substance regulations. On 3rd November, the Ministry of Finance finally released the template for the economic substance notification and so long-awaited economic substance report that came along with the timeline for filing. Last Thursday, the Ministry of Finance also released the guidance on preparing the notifications and economic substance report, which provides for some important clarifications. It has been clarified in particular who and by when need to do the first reporting. With respect to entities required to file economic substance notifications to avoid ambiguity, which we saw during the first filing of notifications in June, it has been specified that only UAE entities which carry on relevant activities must file notifications. Also, branches of the local company do not need to file notifications separately. Instead, they should be added to the consolidated notifications of their parent company in case they do undertake relevant activity. 31st December will be the due date for filing report and filing, and in some cases, refiling of economic substance notifications. All forms will be filed electronically on the portal to be launched soon by the Ministry of Finance. Can we move to the next slide? Yes, and as just as a quick recap, wanted to remind which entities need to comply with economic substance requirements. The regulations apply to UAE mainland and free zone entities which undertake any of the 9 types of relevant activities defined in the regulations. The new regulations provided for exemptions for certain entities which we discussed during the last webinar. These entities only need to file economic substance notification along with the documents confirming eligibility for exemption. The entities deriving income from relevant activities in the reportable period must meet economic substance test and need to submit the annual report where they will declare if the test has been met. Non-compliance with filing requirements or failure to meet economic substance test are subject to various penalties, including suspension of the trade license and exchange of information with the foreign authorities. In this webinar, we will not discuss in detail new forms of notifications and the information required to prepare the economic substance report. The templates of the same can be found on the Ministry of Finance website. We will provide the link later. However, just wanted to go quickly through the key changes in the economic substance notification form and key challenges that you may face while preparing the report. Overall, we see that the form of notification became more complex and as compared to the previous one requires for additional details such as VAT registration number, the primary regulatory authority, and the details on the ultimate parent company and ultimate beneficial owners for all companies, not only engaged in high-risk IP. There's also a separate tab to select the type of exemption for exempted licenses. It is not clear yet how to upload the supporting document, which would confirm the exemption. There is also a separate field to provide information on the local branches which carried on relevant activity. I was just wanted to note here that the parent company need to file consolidated notification, including branches, irrespective of whether it itself undertakes the relevant activity. Next slide. In terms of the filing of the notifications, notifications must be filed within 6 months from the end of the respective reportable period. In particular, by the end of December 2020, the following entities need to file notifications. The entities with financial period ending 31st December 2019, these entities would need to file the economic substance notifications again. Entities with financial period ending on 31st March 2020 and 30 June 2020. In terms of the economic substance report, which we'll discuss on the next slide, it has been a long time since the introduction of the erstwhile economic substance regulations until the template of the report has been finally released by the Ministry of Finance. If we look at the report, like in Bahrain, it looks like a questionnaire along with a self-declaration on meeting economic substance test requirements. The key components of the report include, besides the general information on the entity, details on the relevant and core income generating activities, financial information as a whole and also attributable to each relevant activity, detailed and confirmation on each economic substance test requirements, information on parent, and ultimate beneficial owner. It is also required now to upload financial statements along with the economic substance report. As of now, we anticipate the following key challenges on completing the economic substance report. The first one, important one, is how to determine operating expenses and accounting profit attributable to each relevant activity. How to ascertain the correct number of full-time equivalent employees for the relevant activity when the employees are involved in different operations, not only relevant for ESR. There could be staff directly involved in performing those operations and supporting staff. In this case, the licensee should maintain the proper timesheets and agree on the method for allocation of resources. In case the licensee failed to perform the core income generating activity in the UAE, the form requires to provide the reasons and the justification why TIGA was not undertaken in the UAE. When core income generating activities are outsourced to third-party service providers, it might be difficult in certain cases to request and to obtain all necessary details from those companies to complete the report. In the absence of the board of directors, which we will discuss further, it is not clear what details and how they should be populated in the report to show that the test has been met. Financial statements now should be also submitted along with the economic substance report. This should be standalone accounts, but there is no requirement at the moment that the accounts are audited. The entities should be prepared to have on plate financial statements, and in case they are not audited, to feel comfortable to submit the same to the tax authority. To summarize, the purpose of the report is to provide the assessing authority, which is the federal authority, with all relevant information on how the licensee met economic substance test in the reportable period. Here we provided for the link where the template can be found, and the same we will circulate after the webinar.
Olga, thanks for that introduction. I think the key, while certainly I think all businesses will need to look at the form and the guidance that they need to, for information that needs to be submitted. I think the key challenge is going to be, and I think you mentioned that there is a declaration that needs to be given as far as the 3 tests are substance tests are concerned, and this is where perhaps if you can talk through what those tests are, starting particularly on the direction and management, and then hand over to Philippe to run through the other tests, because they have more of a transfer pricing focus on it. I think it'll be useful while we've looked at the notification and the guidance to also see what are those tests and what businesses need to do to be prepared to make that self-declaration in the economic substance report.
Right, Nilesh. It's just mentioned that this report, the economic substance report, will provide the tax authority with all information to assess whether the test has been met. Also, the licensees would need to declare if they think themselves that this test has been met. Considering the approaching deadline for filing, it is critical now to understand what this test requires and to ensure that all requirements for the economic substance test have been met in the reportable period to avoid potential implications. According to the economic substance regulations, the entity must satisfy the following 3 criteria to meet the test. The first one is to conduct the necessary core income generating activity in the UAE, to have adequate substance in the UAE in terms of employees' expenditures and premises, and that the relevant activity must be directed and managed in the UAE. So in the next slide, we will go through each of the requirements and discuss some practical cases and challenges. As for the directed and managed test, What does it mean for the relevant activity to be directed and managed in the UAE? The regulations and supporting guidance set out the following conditions. The board of directors must meet in the UAE at an adequate frequency, having regard to the decision-making required at that level. The economic substance regulations recognize that could be some regulating laws issued by the respective licensing authorities, like, for example, free zone regulation, or the decision-making process can be set out in the constitutional documents of each license. At such board meetings, there should be a quorum of directors physically present in the UAE, which does not mean that directors should be UAE residents. They just need to be present in the UAE while taking the strategic decisions in relation to the relevant activity. Directors must have the necessary knowledge and expertise to discharge their duties. They should not merely execute decisions being taken outside the UAE, if this is the case. The minutes of board meetings must record all strategic decisions, must be signed by directors present in the UAE, and must be kept in the UAE. Overall, I would say that requirements look pretty straightforward and are in line with international practice. However, we have seen in practice some cases which may deviate from the above scenario. The typical case is when small or medium enterprises or family-owned business simply do not have the board of directors. It might not be required by the free zone regulations or by constitutional documents of those entities. In this case, two scenarios are possible. The first one is when the entity has a general manager or a sole director who runs the company. For this case, the Ministerial Decision 100 clarified that the above-mentioned conditions for the board of directors would apply to the extent possible. What does it mean? For example, it's just as a practical solution, the management body of the entity, which could be a general manager, a CEO, or any person assigned to manage the company, should have the necessary knowledge, of course, and the expertise to take the decisions pertaining to relevant activity, should take these decisions while being present in the UAE, and these decisions should be properly formalized through the written resolution and kept in the UAE. Another scenario, which could be associated with a quite high risk, is when the local company is effectively managed by the foreign shareholder. In this case, to meet the test, it could be advisable to appoint a local director to take the decisions locally, or to ensure that the representative of a foreign shareholder authorized to take the decisions fly to the UAE and take the decisions here at an adequate frequency. The third practical case could be relevant for the group companies with headquarters in the UAE. For example, such group of companies may have a board of directors sitting at the level of the ultimate parent company, which would take decisions in relation to all group companies. In this case, the risk of not meeting the test would be lower, as the decision-making is done locally, which is in line with the objectives of the economic substance regulations, but still fully to meet the test, it could be recommended that each entity would have a management body, which would consider and formalize the decisions taken at HQ level. I would also pay your attention in the above case that there could be a risk of not meeting the economic substance test or the same test, directed and managed test, in the foreign jurisdictions which also implement economic substance regulations, like BVI, Cayman Islands, or Bermuda, for example. Therefore, we strongly recommend reviewing the corporate governance structure of the entities in those jurisdictions, if your group of companies would include offshore jurisdictions, against the applicable requirements. Now, I would like to pause and hand this over to Philippe to discuss other economic substance test requirements, as they seem to interplay with the transfer pricing considerations.
Thank you, Olga. And yes, from a kind of economic substance rules perspective, it is very interlinked with connected persons, and then the connected persons is a kind of sphere of transfer pricing. But when we're talking about core income generating activity tests, let's first talk about core income generating activity. So every business has to perform a set of functions and activities in order to be able to generate revenues and profits. And depending on the value chain of a specific business, some of the functions will be more critical to the successful performance of operations than others. And if we go to the next slide, we'll see that the expectation of the SIGA test is that these kind of core functions are performed in the United Arab Emirates. Now, the regulations provide a number of kind of overviews of a list of functions that are expected to be performed. There is an interlay here with the transfer pricing rules, especially in intellectual property, where there is a kind of direct reference to the DEMPE functions, and there is a clear expectations on research and development, branding, marketing, and distribution. Then and we selected here a couple of ones that I think that majority of the people on this webinar will be impacted with, is distribution and services. So you're expected to manage inventories or to take orders as a function. For headquarters, you will be taking relevant management decisions, incurring operating expenditure that is for the benefit of the group, or you will coordinate group activities. For lease finance, we have agreeing funding terms, setting terms and duration, managing risks and exposure, and monitoring the performance of the financial asset. So I think that based on the list, there is no kind of big surprises. We have to have certain functions. Now, the list that is provided in the ministerial cabinet resolution and the decision is not exhaustive, and the economic substance report kind of provides you an option to put other fields which are in line with your specific value chain. So I think that there is an interlay here with transfer pricing, because these are functions that you need to perform, and then you just have to make sure that they are done here. Now, the regulations go on to specify that if you are kind of not in capacity to perform the core income generating activities within your company, you can outsource the activity as long as certain conditions are met. And if we can go to the next slide, I think that we can go to these outsourcing considerations. So the regulations specify that you can outsource any or all of your SIGAs to UAE-based third-party or related party suppliers. And you can use their employees, their physical assets. But the thing that you cannot outsource is the directed and managed test. Now, if you are outsourcing a part of your core income generating activities, there are certain restrictions. You need to demonstrate that the outsourced core income generating activities are undertaken in the UAE. You need to ensure that you have the proper supervision of the outsourced activity. And there is now a requirement in the economic substance report to demonstrate, to provide accurate information about the outsourced party activity and the outsourcing party adequate substance in the UAE. Finally, there is a kind of consideration that you don't have to double count these things. Now, there's a lot of kind of discussions on how we're going to document these things and how we're going to provide sufficient information to confirm that the core income generating activities in here. Now, in case of outsourcing, I think that we're starting with a clear kind of overview, which is, do we have a contractual agreement set up with the outsourced party, which in details covers the activities which are being outsourced. There's a lot of practical challenges in terms of how do we document and how do we sustain all of this, because there is a lot of outsourced service providers that are reluctant to share company details, the numbers of employees or premises information, because they consider this to be a secret. Now, how do we also put in place a proper supervision system? This also can be a challenge for some of, and was a challenge for some of our clients. And then if you are having kind of in-house core income generating activities, well, do you have a clear allocation of resources? Because one person may wear many hats that and be responsible for a number of activities. So I think that there will be practical challenges to demonstrate outsourcing in special, and then to kind of have a clear overview of what the functions are that you are that you are performing in-house. So some documentation will have to be maintained there. Then if we go to the next slide, we're going to be discussing about adequacy. And adequacy is a term that I think is the most used in both the ministerial decision and the cabinet of minister resolutions. The ministerial decision has 17 references to adequacy, while the rules have 8. And if we go to the next slide, let's see what it is. So adequacy is based on 3 poles, based on employees, where the expectations are that you will have an adequate number of qualified full-time employees in relation to the relevant activities that are physically present in the country. Then that you will have adequate operating expenditure incurred in respect to the relevant activity. And finally, that you will have adequate physical assets or premises within the unit. Now, for adequacy, you are also allowed to outsource all above, but providing that the outsourced service provider is able to demonstrate the adequate supervision of the outsourced activity. Now, if we go to the next slide, there is a kind of additional number of precision of what the intention of the rule is. And they're saying, well, you have to have adequate number of qualified full-time employees on one side, but then the intention of the rules is not to impose requirements on businesses to engage more employees than is actually required. Then they go on saying that the number will be dependent on the nature or level of the relevant activity and the level of income which is being used. Then there is a requirement to maintain sufficient records to demonstrate the adequacy and appropriateness of the resources utilized and the expenditure incurred. Then there is a couple of kind of smaller precisions that the premises, you can own them or lease them, then that the directors of the company may be considered employees, and that you are expected to take a pragmatic approach, that the regulatory authorities are expected to take a pragmatic approach when assessing whether you as a licensees have met the ES test, recognizing type and level of activity of a license. Now, this is all to a certain extent, in my perspective, very vague and very subjective. So this is where I think that the biggest interlay with transfer pricing comes. And if we go to the next slide, so what do we do in the transfer pricing analysis? Next slide, please. Well, transfer pricing in the recent year is all been about aligning substance with value creation. And when you take a look at the adequacy test required to be met by under economic substance, well, it's a derivative of the personnel employed, assets utilized, and the expenditure incurred, which is very similar to a functional analysis that we prepare for transfer pricing purposes. So economic substance tests, in order for you to assess on whether you have the adequate substance or you're meeting the adequacy tests, can be to a certain extent constructed to look like a smaller version of a transfer pricing functional analysis. So to understand what are the activities which are being performed on the ground, where do they sit vis-a-vis the value chain, and then I think that there is a need to align these two. So economic substance and transfer pricing going forward will go hand in hand in future years. Now, if we go to the next slide, let's go into some kind of more practical considerations of what is an adequate number of and cost of employee. The onus to demonstrate that you have the adequacy rests with you. So I think that when you're taking a functional analysis, you're going to take a look at the headcount, skill set, roles and responsibilities of the employees or the directors that you have within the company, and then you're going to stop and ask yourself on how do I compare whether this is adequate? Well, you can use a quasi-benchmark analysis based on public available databases where you can compare your operations or your key performance ratios with a number of industry peers which are operating, for example, in the region, and or if you have data on your main competitors, and you can kind of compare on where do you stand, whether a competition to use this as a support for your activities. If we go to the next slide, then we're talking about allocation. And the economic substance report format basically requires you to provide a separate accounting profit or loss and the accounting expenditures which are related to the relevant activity. So if you have a company which is doing kind of multiple business lines, out of which some are relevant activities or some are not, well, or if you have multiple relevant activities, you're going to be in a need to prepare segmented financial statements. How do I prepare segmented financial statements? Usually revenue is easier to identify, but then you come to the allocation of costs and operating expenditure. And I think that the OECD guidelines have very kind of much content that you could use to understand on how the split of operating expenses could be implemented and what are the allocation keys that are normally applicable in the market. Then there is also kind of a possibility to use cost-sharing agreements for clear allocation of resources and costs. And then there are some more complex ways on how you could do it, which is, let's say, keeping timesheets, which are usually only done for service companies. And then the question was whether you had them in 2019 or not. But I think that relying on transfer pricing guidelines could give you a view on how to do allocations. Then I think that we had a nice practical example, which is on the next slide, which is related to lease finance business and the sources of funds. So we had a couple of clients, and some of them were doing a kind of intercompany loans. One were in a back-to-back position, so their headquarter would give them funds, which then they would on-lend to their related parties. Other had revenues from dividends, and they were able to self-finance loans to subsidiaries. So what are we testing? Are we testing the adequacy of the interest paid? Are we testing the revenue of the income of the group? This is kind of a transfer pricing exercise. But we also have to make sure that we have the adequate kind of resources to manage this thing. So there is input interest expense, there is an output interest expense, and there is everything that goes inside. And this may vary depending on whether it's your own funds or not, on what your management will be focusing about, just managing the performance of the loan going forward, also monitoring the risk that is coming in. I think that these things, to a certain extent, clarify or summarize on what we observe as the interlay of transfer pricing and the economic substance rules, and some tips that will help you in kind of performing your calculations. Back to you, Miloš.
Thanks, Philip and Olga. I think we've got a number of questions that are coming through thick and fast, so I do want to get to it as soon as possible. But there's lots we've talked about, both in terms of the practical issues on the economic substance report and the notification and what information needs to be submitted. And then Philip, you've talked through a number of issues, very relevant ones on the substance test, and in particular looking, seeing how we could look at, or how businesses could look at the adequacy criteria and what the role of transfer pricing has. So, we'll run through the questions very quickly, but just before we do that, Philip, what would be your view on the 3 or 4 key takeaways for clients or actions after this webinar in the run-up to the notification and the reporting deadline?
Yeah. Well, first and foremost, and this is kind of given, next slide, please. You have to submit the notification and you have to submit the reports, but I think that this is already a given. Now, I think that one of the key points is to ensure that sufficient documentation is maintained for making strategic decisions. Then I'm referring to the discussion there. I'm referring to the discussion that Olga was having on the managed and directed tests. And I'm just going to step back and say we're reporting 2019. So you have to take a look back and say, hey, did we have the minutes of the board documented? If not, did we have any email communications or any kind of appointments or any supporting documents that we could use to substantiate that these meetings have actually occurred. And if we don't have a procedure, well, 2020 is almost over. So I think that you have to make sure that you put systems and procedures in place to make sure that for years going forward, this will be structured. Then, especially for the core income generating activities, do we have some kind of transfer pricing documentation from the group that or made for local purposes that we could use to substantiate the core income generating activities, which they are, and why did we select something that we did in the report? Then do we have a good overview of what is outsourced and how do we manage? And then finally, year end is coming very close. How do we segment the financial information, and did we put the segmentation in place to meet the requirements of the economic substance report and the economic substance test expectations? That's it from my side. I think that there is a lot to do or to finalize within the next 2 months.
Excellent, thank you, Philip. And what we'll do is move on to the Q&A. There's a number of questions that have come through. Let's try and cover as many as we possibly can. So starting off with the notification and reporting template, and Olga, if I can request you to take this one. There is a question that's come in that, two questions relating to notification reporting. One is, if there is an entity with multiple trade licenses, both in mainland and free zone, notification and report that needs to be filed, or are there multiple filings required? And related to that, there's a question around exemption and what kind of documentation needs to be uploaded to substantiate the exemption claim.
Thank you, Nilesh. Interesting question. I think I would start the first one. Is for multiple notifications. What we've seen, again, as I have mentioned, what we've seen while the notifications were filed in June, it was not clear if the entity has branches, representative office in different locations, including mainland and free zone. Do they need to require the free zone, the notification, each free zone, or they can file a consolidated notification? Now this issue has been resolved. There will be only one portal, one place where to file all economic substance notifications. They don't need to be filed to each relevant regulatory authority. They need to be filed on the portal to be launched by the Ministry of Finance. Then all branches of the local parent company need to be added to the consolidated economic substance notification of the parent company. They need to be added only in the case when they undertake the relevant activity. So I think the first step would be for each entity to see if, for example, the parent company undertakes the relevant activity, and if it has multiple branches, which branch undertakes also the relevant activity. And these branches would be included in the one notification, one single consolidated notification, which would be filed by their parent company.
Thank you. And I think, Olga, there is a slight difference where the parent company is located outside the UAE, correct? So if you have foreign parent outside, but you have multiple branches, then I believe you need to submit separate notifications for each.
Yeah, right. Yeah, so I think my example was in particular to the local companies which have local branches. In case there's a foreign company, that would be considered as a separate entity, and its branches would need to file separate. There's no clarity if, for example, the foreign company has several branches registered in the UAE. For the moment, there's no guidance, no clarifications by the Minister of Finance if it can also consolidate all branches in one single notification.
Right. So I think clearly, pending further confirmation, I think the working assumption needs to be that branches of foreign companies where they do carry on relevant activities do need to file multiple notifications. So just coming back to you again, Olga, before I come to you, Philip, again, there are a couple of questions on board meetings, because that seems to be a practical issue for most businesses. First is around the requirement to have physical board meetings given the current travel restrictions on COVID, and what's our view there. And there's a second one relates to if there's a change in directors 19. So 2019, there was a different set of directors. 2020, there are different set of directors. Who do you, who's responsible for filing the notification and the report, given that the directors in 2019 are not the directors in 2020? So a couple of questions on directors and meetings.
Talking about the first question on the physical meetings of the board of directors, just recall there was announcement by the Ministry of Finance in May last year when they recognized actually the current situation and that it may have an impact on the mobility of the individuals across the world. In that particular case, they just said that there could be potentially restricted mobility of the individuals, of the persons assigned as the or the members of the board of directors. In that case, it was recommended to assign alternate directors, which would be present in the UAE and which would be present during the board meetings to represent those directors and take these decisions locally. There will also not recommended, but it basically was confirmed that the meetings may be held virtually. And in that particular case, they would need to record those virtual meetings just to have the evidence that the meetings were held. But that was only relevant to 2019. And let's see if the same would apply going forward. But yeah, the current situation was taken into account by the Ministry of Finance. I would say that if, for example,
sorry, you mean 2020? 2020.
I mean 2020. I mean 2020. Yeah. But since the now reporting is done for 2019, I think that should work. That should be doable. The only case that should be in evidence that those meetings were held virtually and they have records to confirm it. Probably to justify why certain people couldn't fly to the UAE. If this is the case.
And so the second question in terms of change of directors from 2019 to 2020. There is a different set of directors in 2019 and different set of directors in 2020. Who is responsible for submitting the notification and report?
Here I would divide it in two different questions, if I understood the question correctly. In terms of the directed and managed test, we'll only look at the reportable period, which is 2019. So we look at how the entities were managed or what the composition of the board of directors was in 2019. Who was at the board? How they formalized the decisions through the written resolutions? Who signed those? Who signed those resolutions? Or who was present at the board of the meetings, which would be confirmed by the protocols? So this is one point. The directors might change in 2020, and the following changes, or the respective changes, would be further reported in the economic substance report and supporting documentation for 2020. With respect to filing economic substance notifications, it's a similar case what we had for the first filing of economic substance notifications. The form should be signed by defined person who is authorized to sign the documents on behalf of the company and it can be responsible for answering or responding to potential questions raised by the Federal Tax Authority, by the Regulatory Tax Authority, whatever. So it does not necessarily be a director of the company or member of the board of directors. It could be any person who has authority to respond to such questions on behalf of the company.
Yeah. Thank you, Olga. That's very comprehensive. Thank you. Yeah, Philip, coming to you, and the for benefit of the audience, just conscious of time, if you're able to bear with us for another 3 or 4 minutes, there's some interesting questions that's come through. It'll be great if we can have you for another 3 or 4 minutes, please. Philip, coming to you, there's a question on SIGA and outsourcing of SIGA, and you've talked about the requirement for there to be an agreement in place and for there to be no double counting. So the question that's coming is, how does one ensure that there is double counting? Does it mean that both the entities in picture, i.e. the one that's carrying on a relevant activity and the one that's the outsourced service provider, do they both have to consider each other's economic substance report before filing? because that's something which is going to be practically a challenge, especially if you've got third-party outsourced service providers.
No, I would say that you don't have to take a look at each and everyone's economic substance report. I would have to say that you have to take a look at your licensees' operations and to understand that there is no double counting of functions within the company. So you would take a look at the kind of organizational chart, responsibility matrix, and these sort of things to understand of whether the outsourced service provider is responsible for the same activities which somebody in your organization is performing. In this case, it would be a double counting. Now, there needs to be a kind of a difference of what is double counting and what is the supervision of the outsourced activity, which is an additional layer there. Olga, did you want to add something or on that respect? But I think that it is based on organizational charts, based on responsibility matrices, and based on kind of responsibilities of a particular job posting that you will be able to conclude on that one.
Thank you, Philip. The next one really relates to, again, relating to this allocation of FTE, where you've got employees involved in multiple activities. Philip, again, if you're able to address that. You've talked about the interplay with transfer pricing. How do you actually come up with that adequacy, as well as the appropriateness of calculating FTE when there are individuals involved in multiple activities?
Now, the base and the kind of best potential solution is to keep track of your time on what you're working in one activity or the other. This is practically very challenging and difficult, especially when you're going back in 2019, when it is kind of difficult to recreate this. Now, I would say there is always at least an estimate that the respective person can be making in terms of what is the time that he was devoting during the year, and that can be used as the best approximation of how to split the expenses and how to split kind of make a ratio of the full-time equivalent. So that is from a kind of employee side.
Yeah. Okay. Thank you. Just coming back to you, Olga. There's a question specifically asked on what is the documentation that you need to submit if you are claiming an exemption, particularly in the context of UAE branch of a foreign company. What kind of documentation needs to be submitted? And are UAE branches really entitled to exemption in all cases, or are there conditions?
No, there are conditions, Nilesh, you are right. And I think this is an obvious question because this case would be quite typical and common for many companies. There's lots of branches of the foreign companies registered in the UAE. So this exemption is subjective to a number of conditions, and of course they depend on the number of supporting documents. It has not been clarified actually in the Ministerial Decision 100, but it's good that now we have a guidance on economic substance notification, and there they specified which documents the licensee need to submit in order to have this exemption. So I will just go through it. This would be the details of the country of the parent company, the head office for tax purposes, tax and identification number of the head office, and the most important, they would need to submit the tax return for the corporate tax purposes in which the income of the branch is recorded. I think that could be the most tricky, a challenging point, because in some of the tax returns, the branch income would not be shown separately. It might be included in the gross income of the overall taxable income of the entity. So this may require to support additional document or computations just to show that the income of the UAE branch conducted relevant activity was included in the total income of its parent company. Interesting to note here that the income of the branch may not be necessarily subject to tax. It may be exempt in the jurisdictions of the parent company, but it should be reflected in the tax return or supporting document.
I think you make it. I think it's a very relevant point, Olga. It is clear that it's not an automatic exemption for UAE branches or foreign companies. You do need to look at how the income is either taxed or reported to tax in the tax return of the foreign parent before claiming the exemption and submitting the relevant documentation.
Yes.
Right. Last, just conscious of time, and I'm going to, Philip, come to you for the last question on this, and it's the question has come, from a good friend and a client, and the question is a lot, requires us to do a bit of crystal ball gazing, Philip. But the question is, given that the regulations and the guidance has just come out recently, do we think the deadline will get extended?
It is.
Putting it in the Ministry of Finance's shoes.
Now, in all honesty, my kind of personal view is the following: the regulations are not recent per se. They are here in the initial version as of last year. So they have been enhanced, they have been expanded to kind of take into consideration OECD comments. But I think that the also push from the international network is to get these enforced. So I don't foresee a delay in the implementation of the rules, or me personally, I would be surprised to see this, because by the level of efforts that the Ministry of Finance has been putting recently, the introduction of the FTA, the publication of all the notifications, all the reports, and the kind of put live, which is expected very soon, I would be very surprised to see delays in this respect.
Yeah, great. Well, thank you, Philip. Thank you, Olga. That's all I think we've got time for. Just want to take this opportunity to thank everyone in the audience that have attended our webinar. Thank you very much for your time, and apologies if we've not been able to cover some of your questions. We'll try and come back to you on a one-on-one basis with the answers. Just as a reminder, if you could complete the feedback at the end of the session, we'd much appreciate that. The webinar is being recorded, as I mentioned, and you will be sent a link to the webinar and the slides, to the recording and the slides within 48 hours. And finally, clearly the KPMG team is delighted to have held this WebEx, and we're here and available and keen to support you as you get prepared with these filings. So please do not hesitate to contact a member of the KPMG team should you need any support on the requirements in the run-up to 31st December. With that, Philip, Olga, thank you very much for your contribution, and we'll be in touch soon with the next version or the next series of webinars in due course. Thank you.
Welcome.